There is a phrase, exactly 7 words, that the banking sector desperately hopes you never utter, that your local property tax authority prays you will overlook, that your Medicare drug coverage provider, your power company, your state tax agency, and 2 additional organizations pulling money from your pocket every single month are banking on you never discovering. The phrase is, I'm over 65. What am I exempt from? That is the whole thing. 7 words. And the reason those 7 words are costing the typical American retiree somewhere between $3,400 and $9,200 annually in charges they were never legally obligated to pay is not because the exemptions are tucked away in some buried regulatory document nobody can find. The exemptions are not concealed. They are publicly available. They are written into law. In multiple cases, they appear in the very same paperwork that created the fee in the first place. The organizations collecting these charges are not unaware of whether you qualify. They are fully aware. They have been fully aware for a long time. They maintain compliance teams that monitor exemption eligibility. They have internal guidelines that grant waiver authority to staff handling qualifying accounts. That information exists within those organizations at this very moment, thoroughly documented and prepared to be applied the instant you make the request. They are counting on you staying silent. And the reason I am choosing to spend the next 30 minutes walking you through precisely what to say, to which person, and at which organization, rather than covering literally any other subject I could address today, is deeply personal to me. My father-in-law spent 8 consecutive years paying a property tax bill in Hamilton County, Ohio, that was $300 higher every year than it ever needed to be. He was fully eligible for the senior homestead exemption, beginning in his very first year of qualification. The county mailed him his assessment each and every year. Not once did that assessment contain a single line reading, "Mr. Kowalski, you may be entitled to a reduction in your bill." He discovered the truth 2 months before he passed away during a casual conversation with a neighbor at a church picnic who happened to bring it up. 2 months, 8 years, $24,800 paid to Hamilton County, Ohio. Money that the law never once required him to hand over. I am not going to allow that same thing to happen to you. Before I take you through all 7, press the like button right now, not at the end of the video. Right now, because the financial services industry, the utility sector, and the property tax collection apparatus all benefit from keeping this information buried, and the algorithm in 2026 consistently suppresses personal finance content that generates direct consumer awareness of institutional billing practices. Every like this video receives sends a signal. Every time someone shares it, one more retiree learns the 7 words before their next billing statement hits. Subscribe and ring the notification bell. This channel exists for the people the system is counting on to remain uninformed, and the standard disclaimer applies here. This video is for educational purposes only and does not constitute legal or financial advice. Specific exemption rules, income thresholds, and application steps vary by state, by institution, and by individual situation. Verify every item discussed here with your actual provider or a qualified professional. But do verify, because the alternative is continuing to pay for something you were never legally required to pay for in the first place. Now, let's go through 7 fees, 7 exemptions, and 7 conversations you need to have before this month's billing statements arrive. Fee number 1, the property tax you are almost certainly overpaying. This is the single largest fee on this entire list, and it carries the highest likelihood of applying directly to your situation right now, today. Regardless of your income level, regardless of what your home is worth, and regardless of which state you call home, 49 of the 50 states in the United States offer some version of a senior property tax exemption, reduction, freeze, or circuit breaker program. The specific label varies, the way it works varies, the income cutoff varies, but the foundational principle holds true across virtually every jurisdiction in the country. If you are 65 or older and you own and live in your primary residence, your state or county has a legally established mechanism to reduce or lock in your property tax assessment. The average annual savings for seniors who successfully claim their state's primary property tax exemption falls somewhere between $1,200 and $4,800 per year, depending on the state and the assessed value of the property. In states where property taxes run high, places like Illinois, New Jersey, New York, and Connecticut, those numbers climb even further. In Illinois specifically, the senior homestead exemption combined with the senior assessment freeze can lower a qualifying homeowner's property tax bill by $3,000 to $7,000 every single year in Cook County alone. Here is the part that should make your blood boil. The application for this exemption is not processed automatically. In the majority of states, you apply one time at your county assessor's or auditor's office. You provide proof of your age and proof that the property is your primary residence. For income-tested programs, you submit the first page of your most recent federal tax return. The application itself is typically 2 pages long. Processing generally takes 30 to 90 days, and once it is approved, the exemption typically renews on its own or requires only a simple annual confirmation form. Here's what makes it worse. The county assessor already knows who is over 65. They have access to date of birth information. They know exactly which homeowners within their jurisdiction qualify for the exemption and are not currently receiving it. They do not mail those homeowners a letter. They do not include any notice with the annual tax bill. They collect the full assessed amount and simply wait for you to figure it out on your own. Go to your county auditor's or assessor's website right now after this video wraps up. Type in the search bar the phrase senior exemption, homestead exemption, or senior freeze. Download the form. Fill it out completely. If you have been paying full property taxes after turning 65 without ever submitting that application, most states will allow you to retroactively recover 2 to 3 years of overpayments. My father-in-law was not eligible for any retroactive recovery. He discovered the exemption too late. You are not too late, not right now. Fee number 2, the Medicare Savings Program GAP. This one applies to a specific income range that is considerably broader than most people assume and considerably narrower than most qualifying seniors realize they actually fall within. The Medicare Savings Programs, specifically the Qualified Medicare Beneficiary Program, the Specified Low-Income Medicare Beneficiary Program, and the Qualifying Individual Program, are federal programs designed to eliminate or substantially reduce Medicare Part B premiums, Part A premiums where applicable, and in certain cases, Part D cost sharing for seniors whose income falls below specific thresholds. In 2026, the QMB income limit for a single individual is roughly $1,255 per month in most states, or approximately $1,704 per month for a couple. The SLMB limit sits at approximately $1,478 per month for a single person. These are monthly income thresholds, not annual figures. And critically, the income that gets counted as countable income under Medicaid rules excludes certain categories, including specific Social Security income adjustments, veterans benefits in many states, and irregular income sources. A senior with a gross annual income of $18,000 may have countable income under Medicaid guidelines of $1,400 per month or less. Their monthly countable income, $200. They qualify for QMB, their Part B premium eliminated. Annual savings, more than $2,200, and they are almost certainly not enrolled. The enrollment rate for Medicare savings programs among qualifying seniors is estimated nationally at below 40%. The primary reason for that staggering gap, nobody told them they qualified. The Social Security Administration, which handles enrollment, does not proactively identify eligible individuals and initiate the enrollment process for them. The state Medicaid agencies that administer these programs do not cross-reference Medicare enrollment data against individual income eligibility to trigger any outreach. The entire system is passive. The senior has to apply, and the average senior has no idea they should be applying because the Medicare welcome kit they received at age 65 referenced the program in 2 brief sentences buried on page 47. Call your State Health Insurance Assistance Program, SHIP, for a no-cost eligibility screening. The number is different in every state, and it is listed in the description beneath this video. The call takes approximately 20 minutes. The annual savings, if you qualify, can exceed $2,000. It costs nothing to apply. There is no reason to delay. Fee number 3. The prescription drug cap your pharmacy isn't tracking on your behalf. The Inflation Reduction Act of 2022 established a $2,000 out-of-pocket cap on Medicare Part D prescription drug spending, effective beginning in 2025. In 2026, that cap is completely in force. Here is what that means in plain everyday language. Once you have spent $2,000 in a calendar year on covered Part D drugs, counting your deductible, your copayments, and your coinsurance, your cost for covered prescription medications for the remainder of that calendar year is zero, not discounted, not reduced by a percentage, zero. Here is the problem. The pharmacy point-of-sale system does not always apply that cap correctly in real time. Billing errors, plan coordination delays, and data synchronization lags between the drug plan and the dispensing pharmacy mean that some seniors actually reach the $2,000 threshold and continue being charged copayments they legally owe nothing on. And even more commonly, seniors who are approaching that $2,000 threshold in November and December have no idea how close they actually are, and so they make decisions about which prescriptions to fill and which to push off based on cost, without knowing that the very next dollar they spend may be the last required dollar of their entire calendar year. The solution is straightforward. Call your Part D plan's member services line in September or October and ask directly, what is my current year-to-date out-of-pocket total toward my annual cap? If the answer puts you close to $2,000, fill every prescription you need before December 31st. If the answer indicates you have already passed $2,000 and you have still been receiving copayment charges, you are owed a refund and need to file a coverage determination request without delay. The plan will not call you to notify you that you have hit the cap. The plan will not send an alert to the pharmacy flagging your account. You have to monitor this yourself and ask the question directly. Fee number 4, the state income tax your retirement income should not be paying. 41 states impose zero state income tax on Social Security income. 9 states currently apply some degree of state income tax to Social Security benefits. But here is the charge that even residents of those 9 states are routinely overpaying. Every state that taxes Social Security income has an exemption threshold, a partial exclusion, an age-based deduction, or an income phase-out provision that meaningfully reduces or completely eliminates the tax for the vast majority of middle-income retirees. Full state-level taxation of Social Security is almost never the actual rule that applies. It is the worst-case reading of the rule, not the reality. Beyond Social Security, 27 states offer full or partial exemptions on pension income, retirement account distributions, or both. The specific exclusions vary considerably. In Georgia, the first $65,000 of retirement income for a single filer over the age of 65 is completely excluded from state income tax. In Kentucky, the first $31,110 of retirement income is excluded. In Mississippi, all qualified retirement income is excluded in its entirety. These exclusions are claimed directly on your state income tax return. They require specific form entries or supplemental schedules. They are never applied automatically on your behalf. A tax preparer who is unfamiliar with senior-specific state exclusions will miss them entirely. A tax software program that has not been updated with the current year's exclusion amounts will miss them entirely. And a senior who prepares their own return without knowing the exclusion exists will miss it entirely without ever knowing they did. This is the category that I find most frustrating about the financial planning profession as a whole. This information is not technically complex. It is not buried or obscure. It is published plainly by every state's Department of Revenue in their annual individual income tax instruction booklets. The exclusion amounts are printed right there on the form itself. And seniors across this country are overpaying state income taxes on retirement income that the state legislature specifically voted to exempt, simply because no one sat down and walked them through page 3 of the state return instructions. Find your state's Department of Revenue website. Search the terms retirement income exclusion or pension income exclusion. If your state offers one, compare the exclusion amount against the retirement income you reported on last year's return. If the exclusion was never claimed, file an amended return. In the majority of states, you can go back and amend returns for up to 3 years. Fee number 5, the utility bill reduction nobody actually applies for. The Low-Income Home Energy Assistance Program, LIHEAP, is a federally funded initiative that helps lower and moderate income households manage the costs of heating and cooling their homes. The income eligibility threshold is set at 150% of the federal poverty level or 60% of the state median income, whichever figure is higher. For a single-person household in 2026, 150% of the federal poverty level equals approximately $22,590 annually. In most states, 60% of the state median income is considerably higher than that figure. A single senior with an annual income of $28,000 to $36,000 may qualify in their state, depending on which threshold the state applies. LIHEAP benefit amounts differ by state, with annual benefits ranging from roughly $300 to $1,500 in most participating states. Some states offer heating assistance and cooling assistance as 2 entirely separate benefit streams, but LIHEAP is only the federal level baseline. Every major utility provider in the United States also operates its own low-income senior rate program or senior discount structure. These programs are governed by state Public Utility Commission regulations and are rarely, if ever, advertised to existing customers. The income thresholds for utility company senior discount programs are frequently higher than LIHEAP thresholds, and in some states, they apply automatically to any customer over 65 who simply requests a rate review. Call your gas company and your electric company directly. Ask specifically, do you offer a senior rate, a low-income discount program, or a budget billing option for customers who are over 65? If the answer is yes, ask what documentation is required to apply. The combined annual savings across heating, cooling, and electricity can range from $400 to $1,800, depending on your climate zone, the size of your home, and your current rate category. This phone call takes approximately 12 minutes. The savings repeat every single year. The information will not appear anywhere on your utility bill. It will not be included in your annual rate increase notice. It will not surface anywhere until you pick up the phone and speak the 7 words. Fee number 6, the bank fee that evaporates the moment you ask. Monthly maintenance fees at major American banking institutions range from $4.95 to $25 per month on standard checking accounts. That translates to an annual cost of $59 to $300, money leaving a fixed income seniors account every month, year after year, that the bank has absolutely no legal standing to keep if the customer simply requests the appropriate account type. Every major American bank, Chase, Bank of America, Wells Fargo, U.S. Bank, Citibank, offers a senior-specific or senior-eligible account tier that either completely removes the monthly maintenance fee or substantially reduces it. The eligibility age is typically 62 or 65, depending on the specific institution. The process for switching consists of a single phone call or one brief in-branch conversation. These accounts are not promoted at the branch level because branch employees are incentivized based on new account openings, not on migrating existing customers from one account tier to another. A senior who walks into the branch without asking will never once be informed that a fee-free option exists. A senior who has been a loyal customer for 30 years and calls the main 1-800 number to raise a concern about a monthly fee has roughly a 90% chance of having that fee permanently waived if they specifically request a senior account review. Additionally, credit card annual fees, which range from $95 to $695 for premium travel-oriented cards, are subject to retention waiver authority at every major card issuer in the country. If you have held a credit card for more than 2 years, carry a clean payment history and call to close the account citing the annual fee. As your reason, the retention department has full authorization to waive the fee outright, issue a statement credit matching the annual fee amount, or move you to a no-fee version of the same card without closing or damaging your account. The issuers do not publish or advertise this. Retention waiver authority is strictly internal policy. It is not disclosed to consumers. The call script is 4 sentences. Call the number printed on the back of your card. Say, I am thinking about closing this account because of the annual fee. I have been a cardholder for X number of years. Is there anything you are able to do to waive the fee or reduce it? Then stop speaking and wait for a response. Fee number 7. The notary fee that is illegal to charge you in more states than you realize. This one catches people off guard every single time. Notary fees range from $5 to $25 per signature at private notary services for estate planning paperwork, powers of attorney, healthcare directives, and real estate transactions. These are precisely the documents that seniors require, notarized most often. The accumulated notary cost across a single planning session can easily reach $75 to $200. In 22 states, banks are required under state law or through their own operating charters to provide free notary services to their account holders. You are an account holder. You have likely been an account holder at the same institution for decades. Every single time you paid an outside notary service to notarize a document that your bank was legally required to notarize for free, you paid a fee that the law never authorized anyone to collect from you. Beyond banks, county recorders' offices in most states provide free notary services during regular business hours for documents that will be filed with the county: deeds, liens, property transfers. Many public libraries offer free notary services to library card holders. Many senior centers make free notary access available on scheduled days throughout the month. Social Security Administration field offices will notarize certain documents for benefit-related purposes at absolutely no charge. The entire private notary fee economy for seniors exists for one simple reason. Most seniors have no knowledge that free alternatives are readily available within walking or driving distance of virtually every home in America. Call your bank branch directly. Ask, do you provide free notary services for people who hold accounts here? If the answer is yes, schedule your next document signing there. If the answer is no, call the county recorder's office and ask about walk-in notary availability. Then call your nearest public library. The sentence that brings all 7 together: now I want you to consolidate these 7 conversations into one coordinated action plan. Write down the name of your county. Write down the name of your bank. Write down the name of your Medicare Part D plan. Write down the name of your gas provider and your electric provider. Write down the state where you file your taxes. And write down the name of every credit card on which you currently pay an annual fee. That list represents the 7 organizations that may be pulling fees from your accounts right now, fees they are not legally entitled to collect from someone who is over 65, who qualifies for an exemption, and who knows to ask the 7 words, I am over 65, what am I exempt from? Speak those words to your county assessor's office and ask about the senior homestead exemption. Speak them to your Medicare SHIP counselor and ask about Medicare savings programs. Speak them to your Part D plan and ask about your year-to-date out-of-pocket total. Speak them to your state tax authority and ask about retirement income exclusions. Speak them to your utility company and ask about senior or low-income rate structures. Speak them to your bank and ask about senior account tiers and available fee waivers. Speak them to your credit card issuer and ask for a retention review of your annual fee. None of these calls requires you to hire an attorney. None of them requires a financial planner. None of them requires anything at all except a working phone and the willingness to ask a question that the organization receiving that call already knows the full answer to. Here is my honest, unfiltered reaction to all of this. And I say it because it genuinely needs to be stated plainly. These are not edge cases. These are not niche programs designed for unusual circumstances. These are mainstream financial exemptions that apply to tens of millions of seniors right now, today, in every zip code across this entire country. The combined annual value of these 7 exemptions for the average qualifying senior falls between $3,400 and $9,200 per year. That is not a minor discrepancy. That is a car payment. That is a family vacation. That is the line between a retirement that feels stable and a retirement that feels like a constant financial squeeze. And the institutions collecting those fees know it. They have the actuarial data. They know their own exemption utilization rates. They know that for every one senior who picks up the phone and asks, there are 9 others who never do. The passive revenue generated by those 9 is substantial. It recurs indefinitely, and it is essentially permanent, because those 9 will continue paying until the end of their lives without ever once knowing they never had to. Share this video with one senior you know today, a parent, a neighbor, a friend from your congregation, the person you see every week at the grocery store who is managing bills on a fixed income and has never once asked their bank, their county, their Medicare plan, or their power company what they qualify to be exempt from. One person today. Because the 7 words cost nothing to say, the organizations are open and operating right now, and the billing cycle does not pause for anyone who was almost going to make that call next week. There is a phrase, exactly 7 words, that the banking industry does not want you to say, that your property tax office does not want you to say, that your Medicare prescription plan, your utility company, your state revenue department, and 2 additional organizations collecting money from you every single month are counting on you never discovering. The phrase is, I'm over 65, what am I exempt from? That is all it takes. 7 words. And the reason those 7 words are costing the average American senior somewhere between $3,400 and $9,200 every single year is waiting for you to change starting today.